Thank you very much for joining us today. I am Alex Scanlon. I am the CEO of Barton Gold. Before we get into the presentation, the image you see on the cover here is not a stock image. That's actually a small high-grade open pit that we have, which is very convenient for us, and I'll detail that in a little bit as we go through the presentation. Big picture, who we are as a company, what we're doing, and why. Barton Gold is a very much pure-play gold-focused company focused on the Gawler Craton in South Australia. So South Australia is a very interesting state. It holds about 25% of Australia's known gold resources, but speaks for only about 2.5% of its actual annual production. This is very much a legacy of a very heavy historical focus on copper and uranium investment and development. And that has happened primarily in the IOCG belt of the central Gawler Craton. You cross the highway, and there is actually a 130-year-old gold province there with a history of high-grade production. It's never really had large-scale systematic exploration and development. We've essentially consolidated every significant historical exploration and production asset in this gold district. So that's about 5,000 square kilometers of tenements that we've put together. On that, we've put together a now recently expanded 1.3 million ounce resource. And we also own the only gold mill in the region. And that's obviously a very important leverage point for us as to our own resources, but of course, thinking about opening up that district, possibly also leveraging the ounces of a number of junior explorers who are coming in around us. So we are focused on the bigger picture, the multi-million ounce potential of this geology. We have a very, very strong team. We're very well capitalized. We actually monetize our asset platform. So looking at us from a general level, corporate standpoint, we have a very tight capital structure, 176 million shares. And we have about $8.3 million in cash. So our enterprise value today trades between sort of 35 to $40 million Australian. And importantly, we have a very strong alignment between board and management and shareholders. So board and management speak for about 1/3 ownership of this business. We have had a very strong share price performance over the past 6 months as we've really started to get significant growth and extensional numbers out to market and sort of focus on getting out and engaging with the market. We focus on our people as sort of our sort of key driver for success. So, again, taking the perspective that we are really much more of an asset developer and an asset manager, which happens to be growing at the drill bit. We have built a team that really reflects our forward ambitions. So we have in our board and senior management about 200 years of experience exploring for, discovering, permitting, financing, building, and operating assets. There's a very heavy focus on gold and a very heavy focus on South Australia. So 3 of my senior team members are ex-Normandy and Newmont. My chairman was the former CFO of Normandy when Normandy was acquired by Newmont to enter Australia in 2002. I also have some of Normandy's ex-project managers and geologists on my team. We have excellent corporate governance. I have the former general counsel and company secretary de Santos. We have a mill specialist on our board. And our CFO is actually running uranium assets for an American defense contractor in South Australia. So it's about as complicated as it gets. So this does really sort of put us in a good position to advance that agenda. And that objective is simply this, to be producing 150,000 ounces per annum as South Australia's largest independent gold producer. So what we are looking for there is a focus on large open pitable mineralization. And this means that we are looking at our Tarkula and our Tonkilia projects. Now, we're focused on open pitable mineralization because, well, it's shallower, it's faster, cheaper, safer, easier to find, develop, and operate. And at Tarkula and Tonkilia, we have around 3,000 square kilometers of ground. On that ground, we've put together now about a 1.2 million ounce resource base. These are 2 assets that are only 70 kilometers, about 45 miles apart from one another. So functionally, they are the same project. And that 1.2 million ounces sits on only about 2% of our known structure there. So we're pretty optimistic about what we're going to find. We also have the luxury of thinking about staging and de-risking the way that we go about developing our assets and hitting this target. So the 150,000 ounce objective is really focused on expanding down into our Tonkilia asset. That's what we call our stage 2 expansion. This will be big, broad, open pitable mineralization. There will be a new second mill built adjacent to the Tonkilia asset. But we have the luxury of leveraging an existing fully permitted mill with existing fully permitted mining leases at our Tarkula project to bring forward some higher grade ounces into stage 1 operations, and therefore take a lower cost and lower risk transition from being an explorer developer into an operator, and then also be able to generate some cash flow on a re-rated basis, both in terms of our equity and credit profile, to then expand into that large scale target. So again, sequentially moving from A to B and B to C on a lower risk, lower cost standpoint. We tend to be of the mentality that value is driven by an achievable objective and risk mitigation. So that's our approach here. Now, we are at pains to explain why we're focused on Tonkilia for that big bulk open pit mineralization, and that is simply that much like many of the projects you'll see in Central and North America, big broad open pittable mineralization is cheaper and more profitable everywhere and all the time in terms of operations. Australia tends to be focused on deep, high-grade underground mining, but we actually, we profile Capricorn Metals, not jokingly at all, as our heroes in the market. This is a team that has now 3 times gone through the market and at Mount Rawdon, Duketon, and now at the Karlawinda project, developed some of the lowest cost gold-producing operations in Australia. And these, again, are based on big, low-cost open-pittable projects. They acquired a project called Karlawinda in 2015. It was a 650,000 ounce asset. They just systematically grew it to 900,000, 1.1, 1.3, 1.5 million ounces. Today, that is now a 2.3 million ounce asset. It's 0.7 grams per ton. And they have developed that as Australia's lowest cost gold only producer. So they're processing about 5 million ton per annum, the conventional CIL plant. And they're producing about 120,000 ounces per annum, right around an average all-in sustaining cost of about $1,200 Australian, so about $800 US at the current exchange rate. So really bottom of the cost curve. Our Tonkilia asset we acquired because when we started doing our diligence, we saw in the data something that we thought looked a lot like a potential second Karlawinda. We have already essentially started emulating our heroes, if you will. We acquired an asset that was 560,000 ounces. We grew it to 965,000 ounces before we IPO'd. We have just now grown it to 1.15. So we have been building a lot of momentum towards this bigger picture. In the time since we listed 21 months ago, we have nearly doubled our known gold mineralized strike. We've found 4 new gold zones. The South Australian government has been an extremely supportive partner. They've given us nearly $1 million in grants. As I mentioned, we are really an advanced asset manager as much as we are a resource developer. We actively monetize our assets, so we've generated about $5.2 million in additional non-dilutive capital net of the cost of generating that capital since we've been listed. And this is how we've taken a 24-month, $15 million IPO budget, and 21 months later, we still have $8.3 million. So we're very efficient with our exploration, but we're also very efficient in extracting value from these assets. The big news for us is about 2 weeks ago, we released an update for that stage 2 expansion asset, Tonkilia. We have grown the resource by about 45% in terms of tonnage, about 20% in terms of metal inventory, and importantly, we've done that at a very low cost. So that was $12 Australian all in per new ounce added to that resource. So looking at Tonkilia, we'll start with that medium term and work backwards. The reason we're focused here on scale is, well, we already have a pretty impressive scale asset, and we are now demonstrating and validating our thesis that indeed it does grow considerably. Around that, we have found multiple additional gold zones, but we are sitting in a very large shear that is basically sitting in a very interesting triple point of regional geology. When we zoom in on the northwest corner there, where we have our 223 deposit, the original footprint is about 2 kilometers long. We've mapped out 3 new gold zones in the immediate vicinity that add another 2 kilometers of mineralization. And the 223 deposit itself, we were always confident that it would grow to depth. The historical drill hole database, if you think about the gold price at which those meters were drilled, we have about a 300,000 meter drill hole database there at that project, about 270,000 meters of which were drilled at probably a weighted average historical gold price of $400 per ounce. So you can only drill so deep when gold is only so valuable. And what we have done in that time is to, 1, grow that, 2, validate a high-grade central resource, and 3, now we've grown it again. So this is the second time we've grown this resource. We grew it in 2020. We modeled it pretty conservatively inside of a an engineered pit-constrained model. And now we've grown it again in April of 2023. We put about 12,000 meters of drilling in to test 3 areas that we thought we'd be likely to get depth extensions. We've added 50 to 150 meter depth extensions in those 3 key zones. And we started to map out a pretty interesting high-grade central zone in the middle. And importantly, one thing to think about is the way that we have modeled this is very conservative. So we are actually modeling this with a production mentality rather than a promotional mentality per se. We have actually modeled this even more conservatively than we modeled it in 2020. We have actually very strictly cut back our grade capping in all of our domains. So we've actually essentially reduced our grade of our deposit. And we've also allowed significant internal dilution inside the model. The reason for that is the geometry of what is starting to come out of this deposit is very interesting, and it is confirming our suspicion that this is going to be a very big, broad, bulk open pit mineralization. So the images you can see here on the left is sort of an oblique three-dimensional long section view of the deposit, and on the right is a cross section through the middle of the deposit. So in the middle of the deposit, we have mapped out now a 300 meter long high grade zone. And what you can see is this is a zone where you have 80 to 100 meter wide mineralization. So this is a literal football field's width, length of mineralized width. And what that says to us is, if we have 2 to 3 meters of waste, we are not even going to slow down as we're plowing through that mineralization. We're going to be mining this with very large, very efficient equipment. We are looking for extremely low unit costs. That is how you achieve a Carlo Winda style outcome. The interesting thing here is that when you look at that cross section in the middle, there is sort of a 20 to 30 meter width where you have mining grades up to 10 grams per ton, and then a higher grade sort of blanket around that at 1 to 2 gram per ton. So within this approximately 1 gram deposit, there's a very nice economic concentration in the middle. So naturally, as we start to think about how might we develop this, you're going to develop down on that high-grade portion. We also then, as you can see, have a very nice supergene blanket that lays across the top of the deposit. So that is about 225,000 ounces, about 40 meters from surface. So as you then start opening up that deposit along length, that is paying for you to do that, and then you are into consistent bulk open pit mineralization as you're going down, and that's a sort of dividend-style approach. So that's very exciting. Everything we've looked at there sits only within the orange box in the northwest corner of that shear zone. All of our modeling indicates that we're likely to have repeats of this style of mineralization down the next 20 kilometers of shear. So we're feeling very confident that that small area in the northwest there will underwrite our 150,000 ounce per annum production plans in time. And Area 51 is one of our regional gold zones. Actually, is a very strong sort of proof of concept that indeed there are repeats of this style of mineralization. That's a unique independent system that sits 5 kilometers from the center of that 223 deposit and exhibits some of the same conduct, you might say. It's a 700 meter long zone right now with a 50 gram meter center. Sadly, it was cut off by a shear at its western margin, but it may have a Siamese twin nearby, but it's sort of proof that you can have repeats of this system. If you have a series of bulk, large-scale open pits, you would love to have some high-grade mineralization nearby that you can blend. This is where Tarkula comes in, and I'll be brief on this. We're 70 kilometers north of Tonkilia. This is the home of high-grade gold in Australia. This is where South Australia had its high-grade gold rush at the same time as Western Australia in the late 1800s. And on our mining lease, about 77,000 ounces were mined by hand from shallow, high-grade outcropping quartz veins at about an ounce per ton. Fast forward 100 years, and a mining lease was put in place. So this is a fully permitted mining lease that holds a shallow, high-grade open pit. This pit was operating in 2018, and the average grade going to our mill was about 3.8 grams per ton. So it was only developed to about 70 meters depth. The former operators actually went out of business elsewhere, and they had to sort of drop tools of an August afternoon. So there's actually high-grade mineralization sitting in the pit floor. We've extended that mineralization 200 meters to depth below the pit floor. And we've also identified a new high-grade zone, which we've called Perseverance West, and that sits just behind the southern pit wall. So we can quite literally drive straight into this pit and straight through the wall, and we're into high-grade material that can go right to our fully permitted mill, which has an EPA license. So we can actually start operations as and when we please. What we're interested in doing is putting some ounces on that pit. All those drilling results in the prior slide are not yet in JORC resource. But we've also mapped out now a 15-kilometer long sort of sequence of high-grade targets that we think are repeats of that mineralization. So we have gone and taken an extraordinary amount of historical data, which essentially work was completely stopped in the area in 1997 because of the gold price collapsing. We have brought in a whole lot of new technology. We have mapped the subsurface domains and structures using ultra-high resolution gravity, aeromagnetics, seismic technology. Now we've mapped, you can see on the image on the right, the structure which created that high-grade mine there on the mining lease. If you look at in the image on the right, to the left there, the left blue circle, there's a target called Warburton, and this sits about 10 kilometers to the west. AngloGold drilled a hole there, which got about 16 meters at 3.5 grams from surface in 1997. Now, they didn't follow that up because the gold price didn't merit at the time, but they did not have the geological context, the structural context that we have now built up, and we have a series of structures now pointing at areas that we had already worked up as high priority targets. So this year, we have, we've been very, very busy already, of course, for the past few years. We are not slowing down. The 30,000 meters of drilling that we've done since IPOing, we're going to accelerate. We expect to be doing another 20 to 30,000 meters of drilling before the end of this year. We are going to further grow Tonkilia. We are also going to start crystallizing resources at Tarkula so that we can come to the end of 2023 and open 2024 with a very clear roadmap towards not only the long-term stage 2, but starting to map out what is the development plan or the path to production for stage 1. So thank you very much. We think we've got a pretty unique story, and I'd be happy to answer any questions. Thank you.